Hi and welcome to the Core Finance Master Investor Show. My name's James Faulkner, I'm the Editorial Director of Master Investor magazine and I'm joined by Victor Hill.
Good morning, James. Happy New Year to you.
Happy New Year
to you. It's good to be back.
So 2017 was a very successful year for stocks, especially in the United States.
That's right.
What makes you think 2018 is going to be another bumper year for stock markets?
Well, may I say it makes a rather nice change to be in optimistic mode and to look forward to hopefully a bumper year. And basically where I'm coming from is that the US market obviously has experienced a very significant upward trend since the advent of Mr. Trump's presidency back in the fall of 2016.
Unexpectedly so as well.
Well, unexpectedly so, though it's been a sustainable upward trend. I don't think that's just a one-off reaction to Mr. Trump's arrival. I think that suggests a long and protracted bull market, and I think that is justified for a number of reasons that we can discuss.
A lot of emphasis is being placed on Trump's tax reforms.
Yes.
Given that this legislation has now made its way through Congress, do you think that the upside is already priced into stock markets, or is there more to come?
Well, not entirely. I think this is the beginning. There's no question that the markets are in optimistic mood. But what we're going to see is these tax cuts are going to feed through into increased profits and increased investment. And that is going to affect the bottom line of corporate America across the board. I mean, this is a very dramatic and very significant new package, which slashes the rate of corporate tax in the United States from 35% to now 21%, which is in line with the global average. Now, a number of sectors are going to benefit, some more than others. We mentioned that mining is going to be one of the most favored. But across corporate America, people are taking on labor, bonuses are being awarded as a one-off, as I mentioned in the article. And corporate America enters 2018 in very fine fettle and in very optimistic mood.
And what about the UK market? Because the FTSE's been a bit of a laggard in terms of the global indices. I think the gains for the FTSE last year were in the single digits.
Yes, that's right. I mean, the FTSE had a pretty lackluster year overall. I mean, it had some upward trend in the second quarter of 2017, but it didn't surpass its May peak until October, and then it retreated. But we saw the FTSE reaching record highs of 7,700 just before Christmas, and that Santa rally has actually been sustained into 2018.
Yeah.
And I just checked, and the market's at 733, something of that order. And the upward trend is clear. Now, the linkage that I make between Britain and the US is that the UK market will not turn south so long as the US market is powering up. And I think there are reasons to suppose that the US market has much further to go. This tax cut represents a stimulus to the US economy of something like $200 billion for the year 2018 alone. And that could add, by some estimates, an additional 1.3% to economic growth. Now, if you think that America is already growing at a rate of about 3.2% as of Q4 2017, we could actually reach the dizzy heights of 4% growth, which was Mr. Trump's target during his election campaign.
Right.
Now, some will say that will overheat the economy. But there's some evidence that, in fact, there's plenty of labor out there, retirees who would like part-time work and part-time people, as indeed in this country, who would like to increase their hours. So that slack could be taken up. And I believe 4% growth is possible. I think corporate profits will continue to increase. And I think we see a Dow heading steadily and surely towards the 30,000 mark. And I even think it could surpass it. The question is not if, the question is when that will happen.
And of course that flies in the face of what all the economists were saying when Mr. Trump came in and
Well,
and had these growth targets?
indeed. I mean, economists are a miserable and gloomy old lot, aren't they? With all the people talking about, you know, the doom and gloom of Brexit over this side of the Atlantic. And now you have Jim O'Neill this morning, a former Goldman Sachs economist, saying that maybe the Romania economists have over-egged the pudding, and that in fact global growth will continue to sustain good growth in the UK as well. But let me give you just two reasons why I think the analysts, or the mainstream analysts, may have misjudged this. I mean, the popular wisdom is that the CAPE, the cyclically adjusted price-earnings ratio for the US market, is at record highs, and therefore a correction will come sooner or later. Well, if you consider that CAPE is calculated on earnings data, much of which was recorded just after the financial crisis of 2008-2009, when earnings were severely depressed. We know that earnings are heading upwards, the technology companies at the forefront of that. So these CAPE trailing measures underestimate the forward earnings potential of many of these major entities on the US market. That's one reason. The second reason is that as we discussed a couple of months back, relating to the US economy overall, there are large sectors of the US market which have underperformed. And I cited in particular bricks and mortar retailers. And there is evidence that these actually have been undervalued and that they could actually begin to resurge this year. If that happens, we're going to easily see 30,000 probably in the first half of this year.
And one area where you see value in the UK currently is the real estate market.
Yes.
What's drawn you to that?
I do. I'm particularly looking at real estate investment trusts. And here you can perceive what we call a triple discount. The first aspect is that the actual underlying property portfolios, or the value of those portfolios, have been undervalued. And the evidence of that is coming through in terms of Chinese buyers buying the walkie-talkie, the cheese grater in the city and so forth, at valuations which are much above their book value. Okay, so that's one thing. The second aspect is that many of these big property companies, and I mentioned British Land, Land Securities, are actually trading at a very significant discount to their net asset value per share. Okay, then you've got the third discount value, which is that the pound is very cheap against the euro. It's about 113.40 this morning. I mean, that's historically at a very low level. It's true the pound is regaining ground against the dollar. It's nearly at 139 now, beyond my expectations as of last year. But nevertheless, the pound is still looking a little bit cheap. So we think that there could be a lot of interest in the UK retail sector. It could be in the UK property sector, in commercial property, particularly in the City of London, where if you go down there, James, you'll see plenty of cranes along the horizon, indicating that there's huge new potential growth coming on stream, despite relatively downward pressure on rents. And you have the fact that in a world of super low interest rates, you can still get yields on buildings in Canary Wharf of around 5.2%, which looks like a good return to me.
Okay, so potentially an area for our readers to have a look at there. What are you writing about in next month's issue?
Well, James, I'm looking at a rather different subject, which is Africa. And I'm getting very interested in emerging markets, as we've discussed, and I will be talking extensively about emerging markets this year. But I'm particularly impressed by the performance of the African markets in 2017. And I'm giving 5 reasons to suppose that that trend will continue in 2018. And if you're looking for double-digit returns, at least in local currency terms, there are quite a few opportunities in Africa, as I shall reveal.
Good stuff. That's all we've got time for today. You can read all of the stories in Master Investor magazine at masterinvestor.co.uk. I'll be back next month. Thanks for watching.
Thanks, James.